My name is Melvin Peters. I'm a director at the DAC Group. We're a middle market investment bank focused on M&A, and I cover healthcare and healthcare services. As part of our 2022 year in review on healthcare services with a focus on home health and home care, we're doing a fireside chat with Angelo Spinola. He is the chair of home health, home care, and hospice at Polsinelli. Angelo's got 2 decades of experience. He's worked with large corporates, privates, and financial sponsors. And we're going to talk a little bit today about some trends in the marketplace and what he's seeing. Angelo, how you doing today?
I'm doing great. Thank you very much for having me.
Excellent. Glad to have you on board. So I think first let's start with a question I like to ask everybody. How did you get your start?
Believe it or not, before I became a lawyer, I was a caregiver. I was a live-in caregiver back in the days of flat rates, day rates. And I was making, I think it was $150 for a weekend of working in a group home with autistic men, 3 guys. And I learned, as much as I loved the industry, I wasn't that great of a caregiver. The things that you need to have as a caregiver, I didn't have all of those things. So I pivoted, did that for, I think it was about 2 years, went to law school and got really involved in the industry, really around the time that the live-in and companionship exemptions changed, when the DOL changed the rules and all of a sudden personal care attendants were entitled to overtime. I litigated that case against the DOL over the course of several years and worked with the national associations and a lot of the providers on that. From there, I started to litigate some of the big class action cases in the home health space around clinician exemptions, and just learned that focusing on this industry, there is plenty to do, plenty of need and help, and having that industry focus and the expertise around how the industry actually works operationally was a huge benefit for me with respect to the type of legal support that I could provide. So I've been at it for a long time, and really 95% of my practice is in that home-based care space.
Fantastic. And I think to underscore one of the things you said, it's unique to have folks that start off as operators that end up in the legal space. There's a lot of folks that start off as caregivers that will start their own agency, or they will join a franchise, but you're a little unique in that you did some work, working with the DOL, and now you become kind of a jack of all trades within the space. You work with a lot of different folks. So thanks for sharing that. Talk a little bit about your practice at Polsinelli.
So I am an employment lawyer, and I represent providers on any issue around their employees, whether that's compliance-based or litigation. There was a lot of litigation to begin with, working with the DOL and responding to DOL audits, a lot of class cases, IRS audits, things like that. And then I really pivoted. I still litigate a lot, but what I found is I was litigating many of the same issues, right? Over and over and over again, litigating the same issues and working with literally thousands of providers. So what we really started to focus on is getting in front of the issue, right? The compliance issue, focusing on compliance programs, making sure that folks are doing things the right way before that big lawsuit hits, right? What would often happen is you get the lawsuit, then the owner would say, okay, we've got to fix this. We can't ever let this happen again. But the cat's out of the bag. By then, it's too late. You've spent a ton of money on the litigation, and you're fixing the problem. So we took more of a holistic approach of, let's look at your organization. Let's identify the things that we know from all of our experience having to fight with the DOL and plaintiffs' lawyers and the like, and resolve that, on the front end. And that led into a lot of diligence work on the transactional side, right? Of having the ability to really quickly dissect a business and know where the bodies are buried, understand what kind of issues they probably have because their neighbors have them as well, right? And we've had to deal with them time and time again. So we were able to kind of laser focus in on a business and sort of identify issues right off the jump because of that industry knowledge.
Great overview. I think it's, again, unique to start off on the litigation side of things and move over to transactions. Normally those sides of the house stay separate. So appreciate you sharing that. On the topic of deals, I know that you're pretty busy over there. What types of deals or transactions do you typically work on?
So I personally work on a lot of the home-based care deals, and what happened is an interesting transition. So I used to work at a law firm that specialized in labor and employment only. That's all we did. And several years ago, I went out on the market basically looking for a full service platform, which is what Polsinelli is now, right? This law firm does everything, and we wanted to be at a full service platform that would be interested in our focus in our industry. And what I was finding at my old firm, we were often hired to do the labor diligence because of our expertise in the industry. Oftentimes we're actually sourcing deals. We're introducing the buyer and the seller because we represented so many companies, and we just have companies call and say, hey, I'm interested in a business in North Carolina about this size or whatever, and we would represent those companies. So we just start putting those deals together, and then we have to go find a law firm, right, that could handle the corporate aspect of the deal, the regulatory aspect of the deal, and then we're handling the diligence. And oftentimes that was three firms. That wasn't one firm that could do it all. So what we went to find was a firm that really could handle every aspect of the transaction, and from a provider focus, do both the buy side and the sell side. So Polsinelli, I'd say it's probably 75% buy side, 25% sell side, but the range of services it's across the entire spectrum of a transaction, both the preparing for a transaction, all the legal aspects of the transaction, change of ownership, those type of things. And that's for any kind of transaction. So the firm does a lot of healthcare deals. I think they did about 300 deals last year in that arena. And then our focus is really on the home-based care, right, where our client base is. That's the kind of deal that we work on, and that really can range from the Fortune 500 companies and the mega acquisitions to the small 1 million revenue, 5 million revenue, right? Some of the programmatic kind of transactions, which this firm is great at handling small repetitive deals that are really, really common in the industry, right? Tuck-ins and the kind of business, whether it's a strategic buyer or it's private equity, right? The ones that are buying up 10, 15 businesses in a year, right? We've got basically programs designed around that kind of transaction that I think is pretty unique. So great platform for what I do.
Sure. And you called it unique, that service offering that you have where you can bundle everything together and serve certain larger groups in a cost-effective and also efficient manner in terms of being able to really help execute on a roll-up or a tuck-in strategy. Definitely think that sets you folks apart. But you also said something to the tune of 1 million, 5 million, $10 million agencies that perhaps could be selling for the first time. Given your experiencing some of these home health and home care transactions play out, what are some of the biggest pitfalls you see with first-time sellers in that category?
Sure, great question. Number one, not starting the process soon enough, right? I think one of the things that we do when we have a new client is we'll ask them that question. Hey, what is your long-term goal? What is it that you want to accomplish? And a lot of times you hear, well, 3 to 5 years, we want to sell, we want to grow and sell. Maybe we'll acquire for a little while and have some tuck-ins, and then once we have a true enterprise, we want to sell. Sometimes businesses don't understand that there's no business that's too small for the right kind of buyer, right? They think they have to be at a certain threshold. That might be true for private equity, but that's not always true for the strategics. And the process that goes into preparing for the sale and what you need to do to be ready, that there's a long runway there. So that's probably number one is get ready sooner than you think. It doesn't mean that you need to rush out and sign an LOI. It means let's kick the tires on the business. Let's do what the buyer is ultimately going to do. Let's do that now and start looking at where is there risk, where are there issues, where are we going to get flagged, and let's start correcting while you've got runway, right? You can burn off the statute of limitations and demonstrate that whatever problems you have been fixed. When the actual diligence comes around, I refer to those as kind of health checks, right? Let's do that now and make sure that your house is in order. And there's a lot to be done, as you well know, and with your support at that group, from an operational standpoint, and that's also true from a legal standpoint. Then when you get into the let's say active sell mode, right? Talk to a lot of suitors, right? Deal making is like dating, right? Your soulmate's out there, but you're going to have to date some people to find her or him, right? You're going to have to look around and kiss some frogs, right, to figure it out. And what I've seen across transactions in this space is there is a wide range of possibilities, right? Wide range of possibilities, and no two buyers are alike. And also valuations, because some businesses have a unique interest in your business, whereas others don't. Some will say, well, that's a run-of-the-mill business. Some will say, well, you're in a market we really want to be in, and we see, even though you're X revenue today, we see a great growth potential here by tacking on your services to what we're doing, or feeding your line of service with our line of service from home health down to personal care, or whatever the case is. There's a lot of value in that. A good example of that is New York, right? Some buyers stay completely out of New York and don't want to touch New York, and some are dying to get in and having a very difficult time because New York has a real limitation on the number of licenses you can have now. So the value of a New York LITSA really, really depends on who your suitor is. And then you've got all the different arrangements of, are you going to stay on? Do you want to continue to operate? Do you want to have an investment in the larger operation, right? When you look at all the different types of transactions and platforms that are available, do you want to just cash in the chips? Are you okay with the idea that your business might flip again in 3 or 5 years if you're selling into private equity, right? What are your long-term goals, both as an owner, right, and for your organization? Understanding that and talking to suitors, the different kinds of businesses, right, that may help you to achieve those goals, I think is a really important piece. And then the final thing I'll say on that, that I've seen over and over and over again is, and it's sort of twofold. One is, it's exciting, especially for the first time seller, right? It's a life event, something that you've been building, and now your dreams come to fruition. And there is, these are long cycle deals sometimes, and the diligence process can take a while, and there's some waiting, and too often you see the ownership get distracted from the operation because of the excitement about the transaction. And so some shoes start to drop, right? The balls start to drop out of the air from an operational perspective, and then the deal doesn't actually happen, and you're left kind of picking up some mess because you've been distracted. And that's also goes kind of hand in hand with why there's sometimes a reluctance to talk to multiple potential buyers, right? Is it's distracting, it's time consuming. So there's sort of a balance there, and kind of a push and a shove. And then the related issue to getting too distracted where you're not focusing on your operations is cluing too many people in too early in the process. You want to keep the information you have high and tight, right? And away from anybody that does not need to know, because you don't want that leaking out. You don't want that affecting the possibility of the transaction going through. And you don't want to create disappointment or concern, whichever side of that coin you're on, from people, unnecessarily. So you bring the people into the transaction as they need to be brought in, and as it becomes more and more serious and more likely.
Yeah, I think you touched on a lot of fantastic points there. A few that really struck home, made me think about our practice at DAC and some similarities. Is at the end of the day, folks like you, folks like me, other professionals, we're really advisors to the business, whether that's an entrepreneur, whether it's a sophisticated financial investor in private equity, whether it's someone that sits on the management team of a publicly traded corporation. We really have a responsibility to them. And one of the things that we can do to help sellers is really just take some of the stress off of them. One of the comments you made was about being a first-time seller and getting excited and taking your eyes off the ball. We always like to tell clients, you want to run your business like you're going to own it forever. So as much as it's exciting and there's this shiny object syndrome that sometimes comes up in sale processes, it's definitely important to stay focused on that, because you really don't know what's going to happen. And a sale might just be a single liquidity event or a single alternative. You might be able to do a recap where you sell part of the business, or maybe there comes an opportunity to transition in a different way. As much as we work in the business of M&A, sometimes the right transition or exit doesn't necessarily need to be a full divestiture recap. There's other alternatives that are available. Another thing that you mentioned as well was New York as a specific example. We've done some work in the Northeast, in the New York region, and the moratorium, the way that laws changed over time, has definitely made it more difficult. But as you also alluded to, with the integration of certain service lines and ways to sell through different types of care, there really are a lot of synergies. And I think one pitfall that sellers sometimes make is they don't think in terms of the breadth or scope of what the market could be. Obviously, there's certain geographies and areas. Florida is another one where, depending on what you do, and if you have exposure to Medicare or Medicaid, it can be a really tough market that certain buyers will stay out of. But there's also an opportunity at times to have a really diverse set of buyers where you might have an outlier outcome. And it's really hard to say what valuation is, because valuation isn't just multiples or some type of cash flow based valuation. It really can be whatever the business is worth to the buyer, right? There might be some reimbursement rate synergies, or maybe they unlock that last geography as a sponsor in terms of having full nationwide coverage, and you don't really want to sell yourself short. The last thing that your comments really made me think about was the importance of starting really early. By engaging someone like you can really get in front of a lot of the issues that can trip folks up during due diligence. And that's one of the things, if I could boil it down to a single adage or two, begin with the end in mind, or forewarned is forearmed. There's no issue or no problem with not having a perfect business. There's no business or no asset that's going to go to market or look for an investment that's going to be perfectly primed at that time to go to sale. But it is important to have a strategy or a plan in place to get around some of the issues that will come up. And as long as you're proactive about it, you usually kind of get around things. And like you mentioned earlier, having that runway, letting the statute kind of run out, those are things that can be helpful too. So I thought it was a great answer.
Yeah, and I think your comment on the different buyer types, right? And then it's not always about the multiple. Really well said. We were working with a business in Massachusetts recently, and the best offer was not the best buyer, right? Financially, it was the best offer, but Massachusetts is a difficult place to operate a home care business, and this particular investor wasn't a home care operator. And the owner was savvy enough to recognize that, look, for the longevity of this business, we don't want to be in a position where somebody is learning on our dime, right? And she had a real interest in what her legacy was and what the business will be after her. and didn't want the business getting slashed and burned, despite the fact that it might have been a higher payout for her. And I think those factors are really significant. And generally speaking, what I've seen is when there's experience, you already have experience operating home care, particularly in the same jurisdiction, but any experience, right, is useful rather than somebody that's coming in from a different industry or trying to break into it. That generally those are the deals that break less, significantly less. And then the same provider type. We've seen a lot of broken deals where the provider is a nurse registry is a 1099 model, and it's a W-2 provider that's looking to buy that. And as they get into the diligence and really start asking, the pertinent questions, they realize that this is not an apples to apples comparison. And for us to be able to operate that model is going to require a completely different skill set. So I think that's a really, really astute point, that knowing who your buyer is and diligence really being a two-way process, right? It's not, hey, here's all of our stuff and you tell us if you like us or not. You are vetting that prospective buyer every bit as much as they're vetting you. And that that dynamic has changed a little bit from last year, right? Where it was such a hot seller's market.
Yep.
Where it's not as weighted towards the seller, but it's still, I think, very, very important that sellers really look at who's targeting them.
Yeah, and certainty of close is something that, as you mentioned with last year, with how hot the market was, you had so many suitors that were at the table. We saw a market increase in indications of interest, which is a first round bid or letters of intent, second round follow-up bid. And there was a lot of groups that we asked, because we had a little more leverage, for the most part being on the sell side. We're probably about 80-20 sell side, buy side, where we could ask for certain things that we wouldn't normally get, like a markup of a purchase agreement, or even to get accounting third-party due diligence teams to look at the financials at a high level and kind of give us their read. So when we chose, for a lot of our processes, in instances where we had closed deals last year, when we chose the bidder that was actually going to gain exclusivity and move forth into final negotiation and close, we had a lot more certainty at that point. Because to your comment, there's definitely a major intellectual capital information gap between folks that have been in the space and kind of done the work before and haven't. Everything from kind of getting a feel for reimbursement rates, for knowing how to operate. Your comment on 1099 versus W-2, there's a lot of risk there. And thinking about the market last year versus this year, I think buyers become even more risk averse. So when you think about the contingent liabilities that could arise from not having your employees or your contractors all wrapped up, it's significant. And that's something that, again, by being prepared, you can get in front of that and you can do a conversion. You'll be hit with it when it comes down to the EBITDA adjustments in terms of looking at what the run rate of the business or the cost structure would be going forward. But it's something to get in front of, and something that buyers are, they're drilling into as part of a standard diligence package. That being said, we touched on it a little bit. What other trends are you seeing in the current marketplace now from a regulatory and a diligence standpoint?
Yeah, I think you hit the nail on the head about what you could get away with as a seller and what you could ask for in the good old days, as opposed to in the current market, is different, right? And so I think from a buyer perspective, we're seeing a increased focus on diligence. They're not having to cut some of the corners that to get in priority, right, for the being the preferred buyer that we saw last year. So one big focus is, I think there's a better awareness, believe it or not, that a lot of buyers in this space do not recognize the impact of successor liability to their organization, particularly when it's an asset deal, right? There's this view sometimes that, well, it's an asset deal, we don't have to worry about a lot of these things, and that's not true of several areas, right, of diligence, and that's caused folks to get bit in certain transactions because they didn't
Mhm.
take a close enough look. And one of the principal areas is mine, right? It's employment and pay practices. If you think about what is a home care business, right? It's the caregivers, right? Without the caregivers, you don't have anything. That's your asset. Um, and so if there are pay practice issues, they have priority, right? Regardless of whether the suit is against the seller or the buyer, right? And you own that successor liability as a buyer, regardless of the transaction type. And a lot of companies that previously didn't realize that, right? The sophisticated buyer now understands that. So there's a really hard look into those areas of potential successor liability. Another area where there's been a real focus is on all the stimulus monies, right? Whether that
Mhm.
be the EIDL program, PPP, which is a huge one in our space, provider relief, right? From two perspectives. One, did you qualify? How do you use that money, right? There has been a real focus from our government in investigating those kind of issues, right? We just saw the statute of limitations, for example, on PPP, EIDL that moved to 10 years. It's a 10-year statute of limitations now for an investigation period, and we've seen some of the headlines of people who've been tapped for misuse of those funds, right? That's going to continue, and it's going to continue to come down further down the food chain, right? What you've seen so far are the obvious ones. Somebody got PPP money and bought a Lamborghini in Florida, right? That's pretty stupid, right?
Yeah.
That's easy, but anything over $2 million, that's ultimately going to be looked at. And what the buyers are looking for is, what do you have in place, right, that demonstrates that you were qualified to take this money and that you used it appropriately. That's one, right? Because are you going to be 10 years from today? Are you going to be able to say and trace back, right, how those funds were used? So that's that's kind of from the seller perspective too. Lock that down, right? Figure that out now. And by the way, everything we're talking about, it from a diligence perspective, doubles up as a compliance measure as well, right? So it's kind of the gift that keeps on giving. You deal with these things now, and you're less likely to have a compliance issue where we've got the government investigating our industry at a all-time high rate, and you're preparing yourself for the sale. The other way that the buyer is looking at those funds, not just from a compliance perspective, but did that artificially prop up the business, right, during the COVID years, during the pandemic, right? What was the profile of the business before COVID and after COVID? Because in some respects, things have changed significantly, and sometimes that's for the better, and sometimes that's for the worse. So, is there sort of kind of an artificial shot in the arm that isn't sustainable, right? And there's a lot more sophistication, I'd say, on not just the seller itself, but the market, right? And where's the market going? What's happening with Medicare Advantage? What's going on with the Medicaid waiver rates, right? What do we anticipate is going to happen, from an industry perspective in this jurisdiction, right? That would impact the business, and what is the impact of the actual transaction? What is that going to do? So they'll look very closely at things like your turnover rate, right, and your culture, and is there a way to maintain that culture, or are we going to have caregivers, the primary asset in one of these transactions, leave? And we've seen the buyers get really creative in some instances, especially now, right, with that change balance of power, in how the deal is structured around a little more guarantee about that, right? Tiered payouts, or requirements of a certain retention rate and those type of things, right, in order to get the full payment, right, that the seller is expecting. So there's a lot of concern with the workforce shortage of, what we can see what you look like now. What is that going to mean when we come in, and that's sometimes where you see it's a little too early, right? Communication with the more rank and file of the prospective buyers happening a little too early, and now we've got too many cooks in the kitchen, too many people with knowledge of a transaction, which, as you well know, is a recipe for blowing it up. So I think those are some of the things that are being analyzed, and then referral relationships, the big focus, right? Particularly in an all payor state, right, around
Yep.
anti-kickback laws. Where a lot of sellers think, well, if I'm not taking government funds, I don't need to worry about my referral sources and paying referral sources, and that's just not true everywhere. So that type of regulatory analysis, with the government being so focused on the industry, let's make sure that from a compliance point of view, we're really buttoned up here, and from a longevity point of view, this is sustainable and scalable for us.
Yep. You talked about the end sustainable and scalable. You talked about earlier the COVID-19 pandemic and inflation indirectly, and how a lot of these factors ended up affecting businesses. And I think one thing to underscore from all that, at least from a deal perspective, is that the increased risk aversion of buyers, a lot of it coming from partially the financing market, but also just concern over the general economy. Although I think we both could agree here that the long-term trends for healthcare services are really, really strong. Just means for more structure, like you talked about with tiered payments or with earnouts or with other type like seller note in some cases. There's a lot of different ways to structure transactions, and multiples are down a little bit. But I'd say from a staffing perspective, what are you seeing your clients doing? Because I think the statistic was we had a shortage of about 500,000 or so nurses. It went well over 1 million at the height of COVID, at least within the general space and certainly within home health and home care. How are you seeing some of your clients manage that headwind? Because I know from our experience, when buyers are looking at fill rates and they're looking at turnover and they're looking at longevity of caregivers, ability to staff authorized hours and do it at higher and higher levels. That's a big part of increasing your margin. And it's something that groups are really struggling to do today, I think, throughout the whole market.
Yeah, no, it's a great point, and it's a high focus. And I'll say this because there are businesses that do this well, and that is such a value add in one of these transactions, such a value add when you can demonstrate from a turnover perspective, from a culture perspective, that you're doing it right. It's incredible, and there's no easy fix for this. This is the problem. We're going to be dealing with this problem for a long time to come. I've got a presentation coming up where we talk about these statistics that you just mentioned, and the fact that you're not going to get these caregivers in the United States. When you look at the aging population versus who's entering the job market, even if we just dominated, right, and increased our percentages specifically for the industry, which is not what's happening, right? Mm-hmm. We caregivers leaving the industry for easier industries, right? One of our problems is the barrier to entry, the background checks, the waiting, the training, right? This is a challenging job for a caregiver, right? It's at least on the personal care space, not particularly high wage, and it's hard work. So it takes a special kind of person to do it. And now when you have barrier to entry too, where you've got to wait on the state, you've got to register, you've got to keep up with your training requirements. That's a challenge when you can go over to Walmart and pick up a job at the same rate or higher. Today you can drive for Uber. You can, there's a lot of things you can do that are not caregiving and easier to get into. So I think one of the fixes for this long term, it's probably beyond the scope of what we're talking about today, is immigration reform and creating a visa specifically for caregivers, like we see in Canada, right, in some other states, right, some other countries. I think we're going to ultimately see that we need to find something like that. So there's an advocacy component of it. But as far as the individual provider and what they can do around staffing, the ones, and we work with a lot of clients and have developed a lot of programs, and the ones that seem to be the most successful are when, number one, you keep the caregivers busy, right? Even with a little bit of overtime in there, right? There are some providers that have built-in overtime where they try to keep caregivers around a 45-hour rate, something like that, so that they're not working too much with other agencies, right? Making it as efficient as you can, right? And there's some technology, which is great. It's really coming into our industry finally, right? That's helping with schedule optimization and things like that. Sometimes across agencies, I think we're going to see a lot more of that, of almost like a shared workforce,
Mm-hmm.
because there's such desperation to staff, right? To staff real opportunities that, agencies are willing to share a little more. And we're also seeing, by the way, the government really cracking down on, any type of restriction around worker mobility. You see like the FTC's proposed rule on banning non-competes, and there's a lot of things like that happening at a state level as well. Legislation around that, non-competes, non-solicits, direct hire provisions and client service agreements. There's a lot around, giving the worker the choice to work for whomever they want to. So the focus really has to be on making your organization the most attractive option, right? And the businesses that are doing that well are creating scaled incentives, right? Bonuses that scale up, like by maybe it's percentage of total compensation. Hey, we're going to pay you at the end of the year. If you're still here at the end of the year, you're going to get 2% of however much money you made with us, 2% of your total comp, overtime and all included. And then if you're here with us the next year, it'll go up to 3% and 4%. Interesting fringe benefits, like cool fringe benefits. One of we looked at in a diligence process, we looked at a provider in Nebraska. He was the seller, and his retention rate was it was through the roof. He had no turnover. I'm like, what are you doing? And he had like these really neat, massage days, right, where he'd
Wow.
send, not everybody, but he'd pick, some caregivers and send them off for a spa day, and he was really got invested in the workforce, which was not only, a fringe benefit, but it's a demonstration to caregivers that, hey, we're part of this. You care about us. We matter. We're not a cog in a machine, which is ultimately what it's about, right? Wages are one thing, but it's really about, and when you look at all the surveys, caregivers often will say, look, I don't really feel like I'm a part of this organization. I don't see anybody. I don't see my supervisor. It's me and the client. That's where the relationship is, right? And I'm not very invested in this business. I can take it or leave it. So the businesses that are able to really stretch, reach out to caregivers, give them the type of training they're looking for, help kind of gamify their approach through, maybe it's one of these point systems where they earn points for various things, recognition sort of programs that will allow them to scale their career within your business, right? It's not the same dead end job. They have opportunities to earn more wages, to scale up into different areas of the business, right? To manage, right? Those companies are getting it right, and buyers are really looking carefully at that question, right? Of okay, great business, great revenue, sustainable. Is it sustainable with the workforce shortage that we're in? And let's look at your numbers today compared to a couple of years ago, and let's see what your statistics look like and what folks will say about you. And what do the caregivers say? Clients, important. Caregivers, really important.
Yeah, there's this idea of when you think about HR, and it's a staffing question, but the answer is more so, how do you think about culture in your organization, which applies outside of even home health, home care. I think it applies to all organizations, even the ones that we work in. I think a lot of companies need to consider total rewards for folks. You mentioned fringe benefits, you mentioned tiered incentives. There's non-economic components to that as well. Do people feel like they're part of a team? I think one of the comments you made was a lot of these caregivers only interact with the patients and they don't actually know anyone else. How do you work to make people feel more involved, and how do you make things more inclusive? But that's not just there. That's throughout, I think, a lot of the industries here in the US, and it's going to be interesting to see how different parts of the economy think about solving this, it's called labor tightness issue that we're experiencing. but I think you covered a lot of the good points that some of the innovators are doing in the market. And I think also you mentioned technology briefly, but I think that's another area where there's a lot of, this is a great industry, but it's one that things are sometimes done the old fashioned way. I think there's going to be a lot of opportunities for innovation. And to your comment, the folks that can innovate in staffing, they're going to be the ones that win share and are, some of the winners when we look at the mid to late 2020s. So,
yeah, and I really do think it's going to be for the short term, because in immigration reform, some of the advocacy pieces that we're talking about, that's a long run. That's going to take a while. I think it will happen, but that you're talking about years. So where I really think you're going to see kind of the next leap, the next sort of process improvement is these platforms that are caregiver centric, right? And like I was talking about before, that sharing of caregiver across platforms, that was not a thing in the past, right? There's corporate rating sort of ideas of, well, my caregiver is my caregiver. I think we're going to really see, hey, let's give it, let's put a caregiver focus on, here are my opportunities, here are your opportunities, here are agency 3 opportunities, right? And that caregiver now can fill up her plate exactly how she wants to, right, with these various opportunities, and that volume now increases significantly beyond just your roster. So there's a lot of systems that are coming into place like that, and I think we're gonna see that be the focus over the next couple of years.
Yep. Well, Angelo, this has been a great discussion. Really enjoyed having you on, and look forward to see some of the work that you and the rest of your team do in 2023. Any closing remarks or thoughts?
Let me just say this, because think there is a spirit of the day amongst some sellers. I've seen this. I've gotten some calls recently where businesses feel exhausted, right? Owners are exhausted. They're worn out. They sort of see the regulatory challenges and that type of thing. And I really worry sometimes about folks. If you want to sell your business, great, right? If you want to, like you said, sell and stay on, recap, whatever, great. If that's within your plan. But I just want to encourage folks, this is the industry to be in, right? It's the industry to be in. McKinsey had they released a study recently where they said they estimate $265 billion, right, in aid and cost to healthcare will move from facilities to home-based care by the year 2025, right? We're not talking about long.
Big numbers.
Yeah. Private equity is involved in our space for a reason, right? There's so much interest and focus on our space for a reason. So I would just, encourage folks, don't let, concern, worry, being worn out be the thing that stops you from operating. Don't do that, because you've got a great future. You just have to be astute, aware. You've got to be informed, right? And roll with the punches. But in the long term, you're in great shape. So I love this industry. I feel very honored to be a part of it and to be able to serve it. And I just want to give that word of encouragement to our owners out there.
Likewise, I think it's great note to end on. Angelo, thanks again. Really appreciate it.
Thank you, sir. I appreciate the opportunity.
You got it.